In this video, we're going to be taking a deep dive into how we analyze the numbers. For this particular property, we were not able to visit the property. However, the numbers worked really well for an example. So there are a lot of systems out there that run these numbers. We're just going to take you through what we do. First, we enter the purchase price, $900,000, and then the closing cost. We estimate very conservatively that the closing costs are 2% of the purchase price. We estimate all of our numbers very conservatively so we can determine whether or not we will cash flow with conservative numbers. If we are cash flowing conservatively, then anything else is just a huge bonus for us. So as we continue, we need to enter the loan details. So for our investment properties, we're putting 25% down. That is the standard. However, if you're looking to own or occupy your investment property, you might be able to put less down, 20, 10%, somewhere in there, because you'll be living in the unit. For an interest rate, we're using 6.5%. Again, very conservative right now, but with the fluctuation of the market, we don't want any surprises once we do find a property. Loan terms are going to be 30 years. This is very standard. However, there might be some flexibility if you do want to talk to your lender about that. We're not charging any points, but again, if you're looking for lower monthly payments, then this is something you might want to discuss with your lender. For rental income, we simply use Google. Google comparable rental units in the area that you're looking for with the same number of bedrooms and bathrooms, and input that. So we estimate $860,000 for all of the units in this property. Again, this is super conservative. We always go a little bit lower than what the market value is. Expenses. Most important to pay attention to is the taxes. A lot of your listings will include taxes in the listing. However, you want to make sure the taxes are for the current year. Right now, we're in 2022. If they are not, or if you would like to double check what the listing has, which we recommend, go to the assessor's website, find what the property is currently assessed for, find the city tax rate, figure out what your annual taxes are going to be, and input that. Keep in mind that taxes tend to increase every year as new assessments come out. For insurance, we estimate about $2,000 a year, again, conservatively for our insurance. And then for repairs and maintenance, these are small monthly repairs. Maybe a tenant's sink is leaking, you need to call a plumber. That would be a repair and maintenance cost. So we estimate that to be 10% of the monthly income. Vacancy is also 10% of the monthly income. This is in case you have a tenant leave your unit and for some reason you're not able to rent out your unit right away. You might have to be able to cover the rent for a month or two from that unit and still make your mortgage payments. For capital expenditures, these are long-term maintenance projects. For example, your roof. Roofs tend to last 25 to 30 years. This is not a regular expense you have. However, this is a big expense, and when this expense comes up, you want to make sure that you have savings to cover those. For electricity, gas, water, these are typically things that the tenant will pay. However, please pay attention to your state laws because some states have funky rules about that. We put $50 in for the water just as a buffer in case something needs to be addressed on our end. We'll go to the analysis. The numbers on this look great. Our income monthly is going to be $8,600. That's the green line. And our expenses are going to be $7,724 monthly, red line. That means our monthly cash flow is going to be $875 a month. That's awesome. That is money in our pockets monthly. As you can see, the first year you're making that $875 a month. As time goes on, you're going to be making more and more monthly. All right, we'll worry about this number later. Your 5-year annualized return is 12.5%. In most cases, this is way better than the stock market. In addition, your monthly mortgage payment is going to be $4,266. Now down here, you can play with the numbers to see what it would be like if rent increases or decreases. But the biggest thing to pay attention to is your total cash needed for closing. Right now, this is $240,000. This includes our down payment as well as our closing costs and anything else that may come up that needs to be brought to the closing table. Now you can see our nice little pie chart of our monthly expenses breakdown. Our mortgage, $4,266, taxes we put in as $750, insurance $2,000 a year, and then we have our variable expenses. These are our vacancy, our maintenance, our CapEx, And again, these are variable, meaning that these change month to month. These are not set in stone expenses that we have every month. However, we want to account for them in case they are there and have savings in case something bigger comes up. Our fixed expenses, this is just the water that we put in as a buffer. Now, our returns. What do these numbers mean? Okay, so let's pop this out. Our cash on cash return is the cash income earned on the cash invested in the property. So this is a good number to pay attention to. Our cap rate focuses on people who pay all cash for a property. It's a good number to use when comparing properties. However, it's not overly useful in most cases. And for your net operating income, this is all of your expenses subtracted from your revenue of the property to give you a better look at what you're going to be profiting from the property. So those are all good numbers to pay attention to. And then you have your 50% rule, which we really like to use. The 50% rule takes the total monthly income of $8,600. And the 50% rule says that half of your monthly income is going to go towards your expenses over time. So these are going to be both your fixed and your variable expenses that we explained above. So 50% for expenses is $4,300 a month. That leaves you with $4,300 a month to put towards your mortgage. Our monthly mortgage is $4,266 a month. So $4,300 take away $4,266 leaves us with $33 a month in cash flow. Now, $33 a month in cash flow may not sound very good. However, with this equation, if you are cash flowing at the end of it, you're doing pretty good. So we really like this rule. As you get to the bottom of your analysis, you can see how the property value is going to increase over time. That's your green line. How your equity is going to increase as you make your mortgage payments, that's your blue line, and how your loan balance is going to decrease over time, that's your purple line. So this is just a good tool to look at. If you have any questions about any of the numbers I just talked about, any of the analysis rules that we used, please reach out. We'd be happy to expand on these further. And then if you need any help running your own rental comps or determining what your monthly mortgage payment is going to be on an investment property, please reach out. We'd be happy to help.